Welcome to the WealthWise Show. This program is for informational and educational purposes only and does not constitute investment, legal, or tax advice. Benowitz Wealth Management is a registered investment advisor in the state of Florida. Registration does not imply any level of skill or training. Listeners should consult a qualified professional before making financial decisions. Past performance is not indicative of future results. Now let's get started with the WealthWise Show.
Welcome back, guys, to another episode of the WealthWise Show. I'm your host, Derek Johnson, and today we're going to be talking about IRAs. And so to get started, understand that this content is supposed to be for educational purposes only. It's not intended to be investment advice, nor is it intended to be tax or legal advice as well. We're not part of FRS, Florida Retirement System, so we will make mention of it. Just understand we're not affiliated or endorsed by the state of Florida. With that being said, we're going to talk about something that actually has nothing to do with that disclaimer, IRAs. So what is an IRA? You know, that's something that I hear a lot, and it's a bit surprising because IRAs are a important cornerstone tool for retirement planning, tax planning, estate planning, all sorts of things that you want to do no matter how old you are. IRAs are a key component in a lot of those aspects. And so an IRA is an individual retirement account. It's called something else. I ain't gonna lie, I don't remember what it's called, but I'm just gonna say individual retirement account. So for you finance nerds and be like, well, no, it's really, yeah. And so it's a retirement account, and there's multiple types of IRAs, but the gist of the IRAs is either going to be qualified or non-qualified. And the reason why I'm using the terms qualified, non-qualified is because it's important for you, the listener, the viewer, to understand those terminologies, because when you talk to certain people, you go to institutions or you talk to individuals who are trying to, advise you on things, they may use these type of words, and it's important for you to understand what they mean. And so qualified means it's qualified for, tax deductions, you get certain tax benefits for this certain account. And so there's multiple qualified accounts. IRAs is just one of them, but a traditional IRA is a qualified account. And so non-qualified, well, the counterpart to an IRA is a Roth IRA. And a Roth IRA is a non-qualified account, meaning you don't get any tax deductions by utilizing that account. Now, for those who might be like, well, if I don't get tax deductions, then what is the point of utilizing a Roth IRA? We're gonna get there, All good things come to those who wait. I think I said that right. So before we get to the Roth, let's discuss the traditional IRA and understanding the importance of the traditional IRA. You have things called the rollover IRA and all this other stuff. It's still a traditional IRA. They might have a little taglines because you're rolling over, a 401k into it, but it's still an IRA at the end of the day. And so the IRA, it is going to be essential for those who are planning for retirement or those who may not have planned for retirement, but realize, hey, I'm up in age, I have to start planning for retirement. It's going to be a cornerstone because what it's going to do is it's going to allow you to take money and put inside of that account, and you can deduct whatever you put in off your taxes. So it will lower your tax liability. Yeah, I'm going to zoom. I'm actually going to back up because my hands keep getting cut off and it's really bothering me. But anywho, like I was saying, and so, yes, you put your money in there. Let's say you go to work, you come home, it's Friday, you get your check, You can see your money, you see your Social Security being deducted from your check, you see Medicare deducted, you see your 401k contributions and things like that, you see taxes been withheld and all that good stuff, and you're left with a net pay. Now, you take that net pay, you pay your bills, you do that, but you want to do a little savings. So you take a portion of that net pay and you go to an investment bank. I'm always going to recommend investment banks because their interface, their services is investing. But you can go to any bank, majority any banks, and open up an IRA. But you take that portion, you go to the bank or you transfer it through your phone, and you put that money in an IRA. Now what's going to happen is, at the end of the year, when you do your taxes, your CPA, your tax preparer, or even, TurboTax, they're going to ask you, did you contribute to your IRA for this, tax season? And you're going to say yes. And then they're going to say, well, how much did you contribute? And then you type in the number, and that number then gets deducted from your taxable income for that year. And what that's going to do is, it's going to allow you to benefit from, getting that tax deduction year over year until you retire. And it'll allow your money that's in your IRA, if you invest it and things like that, it'll allow the growth of that money. And so the IRA, it grows, and it grows what we call tax deferred. So tax deferral does not mean tax avoidance. People get that confused all the time where they're like, well, I don't pay no taxes because I put it in my IRA. Well, it depends on which IRA. We're going to get to the Roth eventually. But, you do have to pay the taxes when you withdraw that money at retirement age. Now, you may say, well, if I want to pay the taxes, it doesn't matter when. Well, it does kind of matter, because the ideal of the IRA is benefiting you now, meaning you get your tax deductions. But also, when you're at retirement, let's say you're on a fixed income, you got your Social Security, let's say you got, your 401k, you got, what else? Let's say you got a pension, you are on a fixed income, meaning the amount of money you have is fixed. You're not going to be able to make more money because you're no longer working. And so what is that going to do? That's going to put you in a lower tax bracket. And so let's say the last couple of years before retirement, that's the most you've made. Now, we know Social Security and your retirement savings and all that stuff a lot of times does not equal to the highest gross amount that you are making. So because of that, you will be in a lower tax bracket when you start withdrawing from your IRA. So these hypothetical numbers, I'm not saying these are, real numbers, just hypothetical. Let's say your tax rate is at 20%. Well, if you're being taxed at 20%, where you're on a fixed income, let's say it goes down to 15%. Well, now you just save 5% on taxes by withdrawing at retirement. And you still get those tax deductions from previous years, all those years ago. And so, even though you still have to pay the taxes on an IRA, it is still advantageous for you to use it because you do get tax benefits now while you're working, but you also can get even better a better tax rate when you retire. So a lot of that stuff, I would definitely talk to a CPA, and I say a CPA for a reason. Talk to a CPA because they will help you set up a roadmap to make sure that you're tax efficient, meaning that, you're not overpaying in taxes, you're not underpaying in taxes, you're using the tax laws that are given to you to use and utilize, and you're able to maximize, the money that you're working for. And so that's pretty much the gist of an IRA and how important it is for someone to use an IRA. Now, the next thing that people think is a, best kept secret, every time I turn around, they're like, did you hear about the Roth IRA? And so it's like, it's a little, they keep it on the hush hush or something. Like, no, just an IRA that has a different usage. And so the Roth IRA, I feel like, is something that a lot of people who are just starting out working should definitely get, because, it can be a powerful tool for now and later. Now, you may now get the tax deduction like you would a traditional IRA because it's not qualified, but it allows you to save money. And if you do it right, it'll allow you to not only save money, but when you do retire, you're able to withdraw those earnings tax-free. And so why is that? And so simply put, the traditional IRA, you put money in there and we call it pre-tax money. And so I know people are like, well, how's it pre-tax if I've already been taxed and I'm putting the net in there? And that's because you're deducting it. And so it's kind of like, a wash where it's like, well, it's basically pre-tax money. So because you're able to take those deductions, the IRS is considered that pre-tax money, meaning, it's not taxed because you're deferring the tax to a later date. You're taking a tax deduction now, and then you're moving the tax date for that money later. And so because of that, it's considered qualified. And so a non-qualified account, which is a Roth IRA, meaning you're using after-tax dollars, meaning you're not taking no deductions for putting money into here. And because of that, they're not going to tax you. Because think about it like this. It wouldn't be fair if you pay the tax on your net, you get your check, you see all the deductions and withholdings, and then the IRS, says, hey, the money that you put in this Roth IRA, you're gonna have to pay taxes on that. But like, I've already paid the taxes on it when, I got my check. So that's why you're able to put money in there that already been taxed, meaning if you put money in the Roth IRA, you're not going to be able to take a deduction. And the money that you invest using your Roth IRA, when it grows, because you use after-tax dollars or non-qualified funds, you are able to get the benefit of having tax-free withdrawals. So hopefully I explained that correct. I'm not a CPA. I'm not a tax professional. I'm a wealth manager. I'm an investment advisor. I'm good. I can tell you about stocks, ETFs, mutual funds, like night and day. I got the laws down packed, but when it comes down to taxes, that is not me. But I do know enough to where I understand that this is how these accounts work. But I'm always going to point you and my clients to the professionals who this is their bread and butter. This is what they're known for. So, like I was saying, and so because you have the Roth IRA and you're using after-tax dollars and you get the deductions, what does that mean? Well, one thing we did not talk about with the traditional IRA, which I totally forgot. I didn't forget, but I was trying to figure out where to put it in, but I told you I got ADHD still. I'm putting it in now. If you were to withdraw money from your traditional IRA before you're 59 and a half, which is retirement age, you will get a penalty of 10% plus taxes. So you withdraw money, you pay your taxes plus 10%. So if you're in that 20% tax bracket, it's now 30% because of that penalty. Now with the Roth IRA, there is no such thing as that penalty if you take out what you put in. So let me reiterate. You have your Roth IRA, you put in $20. That $20 grows to $60. Now the $40 that is on top of the 20, that if you were to touch, you'll get a 10% penalty because you're not at retirement age. But your initial $20 that you put in there, you can take out without incurring that penalty. Why? Because it's already been taxed, and is your money. Yes, the, traditional IRA is your money too, but you took a deduction. So you told the IRS, hey, the money I put in here, take away from my taxable income. And so that's why you have that. But because you already paid the taxes on it, it's free and clear. You can do whatever you want with it. And so as long as you don't take out the interest or the appreciation of the money that you put in there, you can take out your principal or your contribution or the money that you put in there. And the reason why that's important, especially for a young person, is because when we are growing, I'm 32, about to be 33. When we're growing and, we get a new job, we're still living with our parents, and as we're growing, we get ready to go to college, we move out, or, you start a business or you start your career, things happen. And so now I don't recommend viewing your Roth IRA as an emergency fund because it's for retirement, but the peace of mind where it's like, I literally have zero choice. I need to go and get some principal out. And being able to do that without no penalties or taxes, that is a peace of mind. And so still, I always preach, if you're young, try to build up a emergency fund, and things like that. But life happens. It's easy to say those things versus, experiencing when things happen and things keep happening. There be shrieks of years of just like, hey man, stuff just keeps happening. And so having that piece of your financial blueprint is going to, give you some peace of mind now, but also is going to give you some peace of mind later, because when you do get to retirement age, you got that tax-free withdrawals, and there is no required minimum distribution. And so that's another thing I didn't mention prior, because I wanted to mention here now. What a required minimum distribution means is with a traditional IRA, the IRS, the government has forced you to take out money because they don't want it deferred forever. They want the money. They want the taxes. And so they give you up until 72 to take money out. And if you haven't taken money out by 72, you are required to make a minimum distribution to yourself and, take money out of your traditional IRA so you can pay taxes. Well, not so you can pay taxes, well, technically, yeah, but so the IRS can get their taxes. But with a Roth IRA, you don't have that option because the money's already been taxed. So they don't care, you can keep that money in there for as long as you want, pass it down, do whatever you want. And, who's the wiser? Now, the drawback to a Roth IRA that a lot of people do not talk about, which I don't understand why, because it's a very simple way to get around it, which I may talk about another time, but I feel like I'm over my 15-minute limit, but we'll push up to 20 minutes, is that a Roth IRA does have income limits. Now, do I know the income limits off the top of my head? Yes, I do. But I'm actually going to read the income limits straight from a government website. So we're gonna go to my contribution limits, Roth IRA income limits. Well, I'm going to go with Vanguard. I don't see it on IRS.com or .org, but on Vanguard, and I quote, that for 2026, which is the year I'm in now, so if you're watching this in 2028, can't help you, I'm in the past, but in 2026, a single filer must have a modified adjusted gross income of less than 130 or 153 $242,000 and joint filers less than $242,000. And so what does that mean? That means if you're over those income limits, you're not able to utilize your Roth IRA. And so that is a lot of money, and that's one of the reasons why they have those limits, because, they don't want people who make a lot of money to utilize those loopholes. They want them to pay taxes. But this is really for people who are, not up of those levels of making money. Middle class, lower middle class. I hate using those terminologies, but for you to understand, you get what I'm trying to say. So what does that mean? All right, there is ways to maneuver around that, but that's not what this episode is about. This episode is talking about traditional, Roth, the difference. But if you're young, you're not making $150,000, when you're, 16, unless, you're a child star or something like that, or an entertainer, or, you're super smart, you did something. And so opening up these accounts when you're younger is extremely important, because it allows you so much time to build up income or build up a tax-free income as you get older. Now, let's say you might, well, Derek, I'm 55. Can I still open up a Roth IRA? You can. Now, the thing about you being 55 is you can open up a Roth IRA at any age. It's just you have to use earned income to put into an IRA, a traditional IRA, and a Roth IRA. So what does that mean? That means that once you retire, you can't use Social Security to put into a Roth IRA. You got to use earned income. And so if you're planning on working another 10, 15 years at 55, then having a Roth IRA, go right on ahead. And that's the sticking point that I've talked to a lot of pre-retirees, those who are planning to retire and within like the next 5 years. They always ask, well, can I just use a Roth IRA? And you can. There's no problem with that. It's just, because you're so close to retirement, having, those 5 years, even if you were to do the catch-up provision and max it out, that's good, and you're going to have a portion of it that's, going to be tax-free. Is that enough for savings, essentially? And so usually they have a 401k or 457 or 43B, or in some cases they have, their pension. Here in the state of Florida, we have the FRS, where they have the pension plan and drop. They have the investment plan, so they have a chunk of money. But a lot of times that chunk of money, it has not been taxed yet. All of it is tax deferred. So they want to roll it over into a Roth IRA. But keep in mind, any money that goes in a Roth IRA has to have been taxed. So if you roll over a chunk of money from drop, your investment plan, or your 401k, your 457, 43B into a Roth IRA, you're going to be hit with a huge tax bill. And so a lot of times, if that's the case, a traditional is the best way to go. But if you don't mind paying the taxes, I don't know who minds paying those kind of taxes when you don't have to. But let's say you don't, then, talk to your financial advisor. If I'm your financial advisor, please talk to me before you do that. But, there's so many different ways to utilize these accounts to benefit you and help provide a nice tax strategy. And so that being said, that's pretty much it, guys. If you have any questions, if you want to know more, please email me at WealthWiseShow@gmail.com, and I will do the best I can to answer them. I know 20 some minutes is very short for this kind of topic, but I'm doing the best I can. And so thank you guys for listening. I appreciate your viewership, your listenership, the downloads, all that. I'm very grateful. And until next time, guys, stay wealth-wise.